Good evening. I apologize. We're running a few moments late. We've had some technical difficulties tonight, and we are ready to start, though. So, being that this is the first Wealth Advisory Review, may I be probably one of the last people to say it to you, but Happy New Year. Happy 2024, and I hope your 2024 has started off well for you. Thank you for joining us for the January Wealth Advisory Review. Got a number of things I want to share with you, and I always, as always, appreciate your time taking to identify what's going on as we share with you what we see happening in the economy and the markets and how that relates to your family wealth management. So, and that mindset, let me go ahead and get started. As always, I remind you of the disclosures. I think that some people in my industry don't like talking about the disclosures. I personally like talking about the disclosures because it's a reminder that we're partners. You have a team of people. Some of you have accountants and bankers and real estate people that you work with and attorneys and so on. I see us as an important piece of your team. And these disclosures remind you that it's not just what we think or even just what you think, but what the team around you has decided makes the most sense. So if we talk about tax ideas, it's always my encouragement. Talk to your accountant. We talk about legal ideas, please talk to your attorneys. If we talk about investment ideas, please review them fully and completely to make sure they make sense for you, for your family, for your situation. So they're not just here for the fun of it. We really think these are an important part of our discussion with you. There'll be a time for questions tonight. So if you have questions, please feel free to raise your hand or type your question in the chat box, and I'll be happy to take that probably towards the end. Although if something comes up that we have an urgent question on, I'd be more than happy to deal with that as well. So tonight, we're going to talk about the market and economic review, as always. I'm going to share with you 10 investment lessons relearned in 2023 and share with you looking ahead into 2024. Also, we're going to talk about the updated portfolio management goals that we want our clients to be thinking about as we move into the spring planning season and then on into investment and insurance review. Remind you of the investment allocation blueprint that we operate with to help you make the most of your family's wealth management and your income and growth needs. Along with that, the income to growth ratio that is so essential to that discussion. I'll share my final thoughts on this at the end to kind of remind you and maybe tie a bow in everything we've covered and answer any of your questions and then remind you of the information for the next Wealth Advisory Review. So now, 10 lessons relearned from 2023. Item 1, nobody is very good at consistently forecasting future markets. Number 2, even if you knew the future, markets are unpredictable. Lesson number 3, don't let politics influence investment decisions. Number 4, diversification is always working. Sometimes you like the results and sometimes you don't. And when I say you, I mean me as well. Lesson number 5, it takes discipline to stay the course through periods of poor performance as all risk assets go through those difficult times. Lesson number 6, assets with poor performance have self-healing mechanisms in most cases. Lesson number 7, great innovations are not always great investments. Number 8, perhaps the Magnificent 7 should be renamed yet again, the Magnificent 3 this time. Lesson number 9, last year's winners are just as likely to be this year's dogs. And lesson number 10, it's China, not the US, whose best days may be over. And I'm going to give you 7 reasons why. Now, when I say these are 10 lessons relearned from 2023, I'm not going to say that I didn't learn anything new this year as well. I think every year, matter of fact, I try to learn something new every day. But I would say that from working with a number of clients this year, that some of these lessons were relearned or should have been relearned. And that's my hope, starting out 2024 by reviewing this information so that maybe it'll help make this year an even better year for you and your family and your wealth management desires and goals. So let's break these lessons down a bit. Lesson number 1, nobody is very good at consistently forecasting future markets. No one is very good at this, and you would think that they would be, but time and time again, we see the difference there. So for instance, if we take a look at let's go backwards. Let's go to 2018. In 2018, the S&P consensus, the estimates for the markets in general, what was anticipated was that we would be seeing a median strategic estimate, an up of 7.5%, as in right here. But what we saw in 2018 was a minus 6.2%, or a 14% overestimate of what was going to happen. And that hurt a little bit. Matter of fact, if you remember 2018, it was really good all the way through the year until that last quarter, and then everything changed. In 2019, the estimates were 13.7% would be what the S&P would do. And this was a consensus, as I'm saying that, a consensus of all of the prognosticators for what market performance is going to be. But the actual returns were 28.9%, an underestimate of 15%. In 2020, the consensus was 2.7% positive. It actually turned out to be 16.3% positive, a 14% underestimate. In 2021, the expectation was we'd see about a 1.2% growth in the markets. But what we saw was a 26.9% growth in the markets, a 26% underestimate. In 2022, we anticipated a 1.2% positive growth. What we ended up seeing was a negative 19.4% in the S&P 500, or a 21% overestimate. And in 2023, expectations were about 6.8%, and the actual market was 24.2%, which was a 17% underestimate. The lesson is, as you can see in the bottom here, especially important one because investors, like all people, are subject to confirmation bias. When we hear a forecast that confirms our own beliefs or concerns, we're more likely to act on it than if we hear one that's contrary. One of the reasons I said that this is one of the lessons that was relearned in 2023, I think that sometimes people think that the hardest work we do is managing investments, managing how investments are performing. That's a tough job. I'm not going to imply it's not, but you know what's harder? It's managing investor expectations. And that word there, confirmation bias. When an investor has a confirmation bias, no matter how much we try to express to them what we think is going to happen, we recognize the difficulty for them to hear that. And so trying to get everybody to have an open mind to what's going on and rethink what we're doing, what they're doing, is a big part of why we do the fiduciary wealth advisory process the way we do it. It's understanding that no matter what we're being told from the media and from resources that we draw information from and resources that you draw information from, there is a strong likelihood it's going to be wrong. Maybe not overestimate or underestimate as bad as this chart shows for the last 6 years, but it is definitely not going to be what we're expecting. Simply put, if I were to say to you back at the beginning of 2023, we were going to have a 25% growth in the S&P 500, you would have said, Frank, that's not possible. It's a crazy year, too many difficult things going on. And I would understand why you'd say that, but obviously the actual S&P returns versus the median strategic estimates were significantly different. So lesson number one, nobody's really good at consistently forecasting future markets. I know you might have your people that you listen to, you're like, oh, they're right on, they're spot on all the time. No one's spot on all the time. So we're constantly drawing information from various sources we agree with and sources we disagree with, because we're trying to figure out what's the best way to go, and then blend that with your risk tolerance, which I'm going to talk more about in a moment. Lesson number two, even if you knew the future, markets are unpredictable. I mentioned it just a moment ago. Imagine that on January 1st, 2023, you were provided with the knowledge that would enable you to see the major geopolitical and economic events of the coming year. Given what happened, it's hard to imagine that any investor would have predicted that the S&P 500 on January 1st of 2023 would rise 26%. And it's unlikely that many investors would have sold equities given the negative news that was coming. It's very likely that they would have not believed what was coming and would have based it on the bias, the confirmation, the knowledge that they currently possessed. So even if you knew the future, markets are unpredictable. And while there were a lot of difficult and challenging pieces of information that came along in 2023, most people would have probably said, I need out of this. I can't take this anymore. As the year went along, some of them started to say, you know what, maybe I should invest now. But unfortunately, one of the challenges that we find is that if we miss the few good days, then it gets hard to make it up later on. So having that commitment to stay invested is another lesson that has to be learned and has to be trusted in to make it work well. Lesson number 3, don't let politics influence investment decisions. We often make mistakes because we're unaware that our decisions are being influenced by our beliefs and our biases. The first step to eliminating or at least minimizing such mistakes is to become aware of how our choices are affected by our views and how those views can influence outcomes. A 2012 study called Political Climate Optimism and Investment Decisions identified that people's optimism toward both the financial markets and the economy is dynamically influenced by their political affiliation and the existing political climate. 2023 wasn't a great feeling for many conservatives. I think that at the beginning of the year, maybe even through most of the year, many liberals or progressives were very pleased. But I think even as the year went along, even progressives and liberals began to identify some challenges, even if they weren't excited to admit them. But in reality, looking backwards now, we can see that the political environment, the geopolitical challenges in the world and in the US, still the markets did very well. So my encouragement is to try to recognize that the politics or the administration or the geopolitical events going on may have some impacts, but they may also have a value that we're not considering. In essence, some bad news creates good opportunities, and some good news creates bad outcomes. But having the ability to see through that is critical, and not letting politics totally control that is essential as lesson number 3. Lesson number 4, diversification is always working. Sometimes you like the results and sometimes you don't. Everyone is familiar with the benefits of diversification. Casting your bread upon the water to 7 yes to 8 portions, that's diversification. Putting your eggs not all in one basket, but in multiple baskets. And done properly, it reduces risk without reducing expected returns. But once you diversify beyond a popular index like the S&P 500, you have to accept the fact that there will almost certainly experience times, maybe even long periods of time, when a popular benchmark index reported by the media will outperform your more diversified portfolio. So you might find that the NASDAQ is going to outperform, or that maybe financial indexes will outperform during a period of time, maybe even a longer period of time. But you can't let that change your view too much. You have to stay the course a bit, because given time, historically and statistically, we can see that a diversified portfolio, when it's done properly, can do well. And so given the goals and needs of investors for their portfolios to generate income, for instance, or to be liquid if they need it, or to be flexible to make adjustments, those are all critical issues for pieces of it. But for your growth portion of your portfolio, what we'd call your growth strat, or your growth strategic aspects of the portfolio, we'd want to have something a little more diversified to a client's risk tolerance. As a matter of fact, you can see here on the screen, I'm showing you the risk reward assessment that shows up in a couple of our applications that we provide to clients. And in this example here, the client had a risk reward of 52, the scoring of 52, which means that 1 is the most conservative and 99, is the most aggressive, and 52 puts it right there in the middle. And it's really important to understand that if a person is comparing their portfolio to, say, the S&P 500, as a measurement of well, this is a benchmark, but if their risk is only half of what the S&P 500 is, it's unrealistic to expect that your portfolio is going to generate the same returns as the S&P 500 benchmark, which would be a 99. And yet, I will tell you, I have clients who they have a more risk averse profile, who will occasionally say to me, "Well, the S&P 500 did this," and we try to encourage them to recognize that the scoring they choose on their portfolio has a huge impact on the outcome, both the reward, but the risk as well. I also included a note here regarding the 2019 Dalbar study, which found that the average equity mutual fund investor underperformed the S&P 500, which is a benchmark of 500 companies in America divided up by 11 industries, by nearly 5% annually over a 30-year span. And the reasons for that are varied, but it typically has to do with the fact that when the market goes up, they have not gotten invested because they were concerned about the market, or when the market goes down, they get out at the bottom and miss the opportunity on the way back up. Versus if they just stayed in the portfolio, and we're going to talk more about that in an upcoming wealth advisory review, they would have found it would be better for them, but they'd have to have that patience, and they'd have to not react to media information or even their discussions with coworkers or neighbors. So what we're talking about here is to take a risk index like the S&P 500 and using that as a benchmark, and understanding that if you have chosen half of the value of the S&P 500, it's unrealistic to expect that it's going to match up to that. If you have a greater risk tolerance, then investing in staying the course, even during some of those more difficult times, as long as it's not affecting your income or your reserve needs, is a much better and a much more appropriate approach to make the most of your portfolio management. Continuing on down here, the noise of the media will test your ability to adhere to your strategies. No one ever complains when their diversified portfolio experiences positive tracking variance, meaning that it outperforms a popular benchmark. The only time we hear complaints is when it experiences negative tracking variance. That is, it underperforms a benchmark. And so one of the reasons we use the risk assessment that we work with is to help clients begin to recognize where that is appropriate for their portfolio and when it makes more sense to stay the course, even though they might not like the current results. So lesson number 4, diversification always works. Sometimes you like it and sometimes you don't, but it does always work if you stay the course. Number 5, it takes discipline to stay the course through periods of poor performance. All risk assets go through them. So if we think about that for a moment, to stay the course during poor performance, recognizing that any risk asset is going to go through a difficult time, all strategies that entail investing in risk assets are virtually guaranteed to experience periods, in some cases long periods, of underperformance. And when I say long, you could be looking at 6 months or maybe several years. It depends upon the asset mix, depends upon what's going on. There are, as you can see here in the next bullet point, if you doubt that, the S&P 500 has experienced 3 periods of at least 13 years when it underperformed riskless 1-month treasury bills. And what that means is during those times, if you put your money into treasury bills or even CDs, you probably did better than what the market did. And those 3 periods are 1929 to 1943, 1966 to 1982, and 2000 to 2012. And so, and for those of you who've been in the office in the last couple of years, you've heard me show, or you've seen me show you that by identifying performance of investing in, say, January 1st of 2000, and how it took till the end of 2012 for you to break even again. And that's a tough road to hoe. Many people don't have the consistency or the confidence to stay put in some of those situations. Now, again, assuming this isn't impacting your income or your cash reserve needs, assuming those aren't being impacted by this, you're getting your income you need and you've got the ability to stay with the modeling, you do get that reward in the end. You get that reward, but you do have to stay the course. So if you take a look at how a diversified portfolio works, maybe you'll divide it into, say, 7 or 8 pieces. Some of those pieces are doing very well during those times, but the risk assets, like in this example, the S&P 500, won't be doing as well. But that's not the end of the world, because over time, 3 years, 5 years, 10 years, you should see that performance and those results in your portfolio. Bullet point number 3 for number 5 is this: to gain benefits of diversifying away from the traditional 60-40 portfolios, you have to have the discipline to stay the course, and even to rebalance in some of those times where the market's down, rebalance it back to its current 60-40 model during those periods of negative performance. And by doing so, you're buying those risk assets at a cheaper price, which serves to benefit you long term. Assets with poor performance have self-healing mechanisms. When risk assets, this is lesson number 6, when risk assets have poor performance or poor returns, it's usually because of a combination of either falling earnings or producing losses and falling valuations. Investors subject to recency bias fail to understand that, and that leads them to sell instead of buying more. And as an advisor, I can tell you that when we go through items like that with clients, it's a tough discussion, because at one point I think there's a sense on their part that, well, I'm just trying to cover myself and not let you think that it is a bad choice or a bad decision we've made. Nothing can be further from the truth. When we're trying to help people stay the course, it's not because we are trying to pretend nothing bad has happened. It's because we're looking at these opportunities, taking calculated risk, and identifying when we think this cycle is going to change, which I'll remind you this cycle here in a few moments. The reality is that recency bias is one of those thoughts where we're looking at just what's happened right now and believing that's the way it's going to be forever. But that's not true either. So having the confidence to stay with something that you started, as long as it's not messing with your income and it's not messing with your cash reserve needs, that's an investment maturity that is a lesson we all can learn. And as advisors and investors, we all have to come together to make a decision to say, I've matched this up to my risk tolerance. I've identified what my reward needs are. My financial plan shows that it's all going to work out if I stay the course. And by doing that, we end up with a better position, both short and long term. So lesson number 6, assets with poor performance will have a self-healing mechanism. Lesson number 7, I find this one enjoyable, to be honest with you. Great innovations are not always great investments. The year 2023 witnessed the fall of several companies that were once heralded as pioneers of innovation. WeWork declared bankruptcy in November. It was valued in 2019 at $47 billion in a round led by SoftBank. It eventually went public in 2021 with a valuation of $9.4 billion via a special purpose acquisition company, a SPAC, not the regular IPO. $47 billion in 2019, by 2021, $9.4 billion in a backdoor effort to make it go public. Bird, an electric scooter company, and I have, in various cities I've gone to visit for meetings or whatever, ridden those little scooters around the city. Bird, I enjoyed it. There's several others out there, but I enjoy them. I've ridden Bird. Bird, an electric scooter company, was heralded as a vanguard in the new sharing economy and was valued at $2.5 billion in 2019, but declared bankruptcy in December. You know, with all the electric vehicles, with all the Uber and Lyft and sharing technology that's out there now, you would think they could do well with that, but that didn't work there. Even Instant Brands, the firm behind a cultural kitchen phenomenon, the maker of Instant Pot, filed for bankruptcy. I can't tell you how many times I've heard people in previous years tell me, oh, that Instant Pot is amazing. And it is. It's quite a piece of technology. But it didn't survive and filed for bankruptcy as well. Their innovations weren't enough to immunize them against economic slumps, slowing sales, management missteps, and a myriad of other issues that caused their demise and the ultimate destruction of immense shareholder value. You may remember or have heard about the dot-com era and what that did, the real estate boom or bubble. Certainly, we're talking about green technologies, and even now, looking at battery technology and AI. All of these are great innovations that will have their time, but that doesn't mean that they won't have stumbles or problems or even outright failures along the way. So while we might tune into our favorite prognosticator about a particular innovation, it's important to understand that even if the innovation goes big, it doesn't necessarily mean that everything we're looking for from a particular investment firm or a particular company or business strategy will generate what we're looking for. So we have to be careful. Great innovations are not always great investments. Perhaps the Magnificent Seven should be renamed yet again as the Magnificent Three. You may have heard of the Magnificent Seven before. They were called FANGs before. We added a couple of companies in. They represent Apple, Microsoft, Amazon, NVIDIA, Alphabet, Inc., which is Google, Meta, Tesla. They all were classified a while back as the Magnificent Seven because when you look at the S&P 500 performance, these seven companies have historically been what has made it, especially in 2023, has made it the performer it was. That doesn't mean the other companies didn't help. I mean, there's 500 companies. This is seven, but these were the stalwarts that made it all happen. To be honest with you, over here you'll see while S&P 500 return for 2023 was 26.4%, the performance of the Magnificent Seven was responsible for most of the returns. That return was 104.7% for all of them combined, accounting for more than 62% of the S&P 500's performance. That performance was greatly affected by investor fascination with the AI story, another great innovation that probably will be amazing and do wonderful things, but it doesn't mean that it will always make the money the way we want it to or in the time that we want it to. Because that now brings me to the second part, that maybe the Magnificent Seven shouldn't be called the Magnificent Seven. Maybe they should be called the Magnificent Three. Three of the Magnificent Seven companies, Tesla, Alphabet, and Amazon, or Google Alphabet, ended 2023 below their closing prices at the end of 2021. Here is, let's see here where we have this. Okay, so here's Amazon. Amazon was 166.72 on December 31st, 21, and it was 151.94 on December 31st, 2023. Google was 144. By the end of 2023, it was 136. And Amazon was 166, but by the end of 2023, 2 years later, it was 151. We'll call it 152. Now, even though the others were good performers, which would be Apple, Microsoft, and NVIDIA, what we find is their performance was only about 3.2% in those 2 years. Now, that doesn't mean that I don't have several clients that are just excited beyond belief of how their Tesla has performed or how their Amazon or Google have performed in 2023. They did well. But if you take as a 2-year number, it wasn't that impressive. Now, is that to say that technology is not important anymore? Oh, of course not. It's very important. And I think the AI story is important, but it doesn't necessarily mean that everything is going to go like we'd like for it to. 2023 happened to be a very good year, but that doesn't mean that 2024 will be for these same stalwarts. So be careful. Keep your eyes open. If you make gains, be ready to take those gains and go do something else with them. It's critical. And if you do that, it will make more sense. But if you're constantly just saying, I'm with the Magnificent Seven, you're going to have other challenges because, again, I'd like to point out here, Apple, Microsoft, and NVIDIA outperformed 1-month treasury bills with only a 3.2% period return per year over that period. And here they are up here, 117 to 192. Microsoft's was 366 to 376, and NVIDIA was 294 to 495. So what we'd like to see is better performance year over year over year, not 100% return in 1 year. But I get it. Investors get excited about things. So a little bit of something is good, kind of like salt. Salt on your meal is good unless you have too much of it, and then it changes it. So good balance, good diversification are critical as another one of the lessons learned in item number 8. Item number 9, last year's winners are just as likely to be this year's dogs. The historical evidence demonstrates that individual investors are performance chasers, and they buy yesterday's winners after the great performance and sell yesterday's losers after the loss has already been incurred. Again, I said a moment ago, managing investments doesn't seem to me to be as challenging sometimes as managing investors' expectations, because they see a winner and they want to grab it, and we'll say, that's fine, let's do it. But when you make the money, getting them to sell it is a different deal. Or they'll see a loss when we say it's time to get back in, but they're looking at the loss and they say, why would I get in? It's lost. But that may be just the right time. You're buying it on sale. I joke with clients, and maybe you've heard me say this, that investors only have a problem 2 times when it comes to their investments in risk assets. That's when they've made money and when they're losing money. When they've made money, they don't want to sell because they might make more. When they've lost money, they don't want to sell because they don't want to be a loser. It's very difficult to manage that sometimes, unless an investor is willing to recognize some of their biases in the discussion and take advantage of opportunities when they show themselves. Bullet number 2 there, this causes investors to buy high and sell low, not a recipe for investment success. The behavior explains the findings from studies that show investors can underperform the very mutual funds they invest in because they miss the best days in that time. Unfortunately, a good or poor return in one year doesn't predict a good or poor return in the next year. And bullet point number 4, in fact, great returns lower future expected returns. The higher it goes, the more likely it could stall. I mean, you recognize an airplane can only go up so high, and pretty soon it's going to fall. So when it only goes so high, maybe take some of that money off the table, maybe not all of it, but at least a good chunk of it, and put that elsewhere in other opportunities that exist. And those future expected returns, which we thought would go up, they actually are below average returns, which give us opportunity for future expected returns. Now, I've identified 6 cognitive biases that impact investors: overconfidence, loss aversion, confirmation bias, recency bias, endowment effect, and optimism bias. In next month's Wealth Advisor Review, I'm going to unpack each of those, because the more we understand about how we look at things like this and think about them, the easier it is to make wise decisions for our future investment choices and our goals for achieving our family's financial needs. Lesson number 10, it's China, not the US, whose best days may be over, and 7 reasons why. Again, the media and many other forces talk about how amazing China is. I would suggest to you maybe it's not quite what you think. I'm not saying it's over. I'm not saying that we shouldn't have any opportunities that are worldwide, but I would say that we should look at everything with, what do the kids say today, a side eye? So here's a couple of thoughts to think about. 1, today, China is the world's 2nd largest economy. From the early 1980s through 2010, China's gross domestic product grew 9% per year, and there were 15 years when it grew at double-digit rates. The early advantages of a centralized economy may have a big impact on that. China is a centralized economy in which the government controls the means of production and allocation of resources. Those controls can provide advantages in the early stages of economic development, as Russia demonstrated after World War II. The Soviet economy grew at a rate of 5.7% per year from 1950 to 1960 and 5.2% per year from 1960 to 1970, becoming the 2nd largest economy in the world. In 1959, a speech at the United Nations, Nikita Khrushchev stated that the Soviet Union would bury economically the United States. Russia had benefited from the advantages of a centralized economy over the decentralized capitalistic economy, and was able to harness those resources to develop infrastructure. In terms of economic growth, the advantages include the efficient allocation of resources in a way that maximizes social welfare rather than profit, and these economies can sometimes grow rapidly in the early stages of development by directing resources to strategic industries and projects. The same effects are playing out today, or could be playing out today, in China, keeping in mind that demographics and productivity are the 2 main drivers of economic growth. And there are other trends that are leading to China's slowdown, and they are as follows. One, an aging population. A significant part of China's economic growth was fueled by a quickly increasing population. China's population is now aging rapidly. There'll be fewer workers to support the growing number of retirees, placing a strain on the economy and leading to slower growth. Slowing productivity. The Chinese migration from farms to cities helped fuel rapid increases in productivity. But that era is basically over. As a result, China's productivity has slowed in recent years, which is another contributing factor to what's going on in their economy. Deglobalization. China benefited from the era of globalization, which is now reversing for national security reasons and to reduce supply chain risks with negative implications for their growth. In essence, we were handing a lot of our industry and our development and our production to China. But after certain events, that began to change, and many nations decided it made more sense to make their medicines in their country or to make their hardware in their country. And so that deglobalization is now working in reverse for China. Rising debt levels. China's debt level are high and rising. Research shows that a negative relationship between economic growth and debt, once the government debt and GDP ratio is above 100%. According to the IMF, China's government debt GDP rose to 76.9% in 2022 from 71.5, and in 2021 it was it was 71.5. In 2013 it was 37%. So we can see it's headed in a bad direction. Now that's not to say the US doesn't have our own problems with that, but that is an impact here that we, because of capitalism and the maturing growth of our economy versus what China's experiencing, may be an opportunity for us to pull our debt back in line differently because of how we operate as an economy. Trade tensions, including the imposition of tariffs between China and the United States, have led to slower growth in exports, which has been a drag on China's overall growth. Distressed property sector. Chinese investors have a high percentage of their net worth invested in real estate. The negative impact of distress in that sector could be as dramatic as it was in the US during the Great Recession. Remember a few years back for us, or maybe even worse, because they have 80 million properties that have nobody in them. And then high unemployment. The unemployment rate among Chinese youth ages 16 to 24 in urban areas has reached a record high of 21.3% in June of 2023, the highest since reporting began back in 2008. The distress in the property sector, the high unemployment among youth, and the declining trust in financial institutions are negatives that are impacting consumer confidence in China. Again, more reasons why this could be a problem. You may remember back in the 1980s, Japan was that next superpower economy that was coming up. And then when we had our challenges in the 80s, so did Japan. But they've still never recovered from theirs yet. And when I say to you Russia, Japan, as I just mentioned a moment ago, and now China, the United States has survived a lot of that. Will we this time? Nobody knows. But I would say that our economy, because of capitalism and the strength of our consumers and the strength of our industry, has a lot of opportunity to see that kind of growth we'd be looking for. Now, I would also add that, again, this goes back to that political bias I just mentioned earlier in one of the other lessons, is that if your political bias says that can't happen because of who's in office right now, you're missing a point that it can happen. We just saw it last year, and it can happen again. And there was a popular radio conservative who commented many times that his success wasn't built upon who was in office. It was built upon how well he did his job. And I would say the same thing is true for all of us, whether it's industry, business, investing, family wealth management. It's not based solely, or maybe even mostly, on who's in office, but rather on how well we work with all of the pieces that are at our disposal when it comes to making wise investment and wealth management decisions. So hopefully these 10 lessons kind of remind you of a few points that maybe as we go into 24 and into future years, we could make some new decisions as we go forward. Looking ahead in 2024, and I just said it a moment ago, I think the first lesson was no one is very good at predicting consistently the markets ahead. But let me tell you some things I do see. Inflation across the developed world has more than halved, all while growth has remained resilient. So we've seen inflation come down. I know that none of us are happy about the inflation that we see at the grocery store. I would also point out, look at the inflation at the gas pump. It's almost non-existent. Look at what's happened with wood. It's gone down since the pandemic. There are a number of pieces that we can see inflation has no longer had the impact on us, and now things have moved back. And we might see some of that with food and other items as well. That strong pace stands to fade, but the recession many of us have fretted over hasn't happened. I've been expecting, we've talked about it, and many of you have been expecting a recession for the last 6 quarters. And there may still be a recession looming out there, but I don't know that it will. With bullet point number 3, the backdrop teed up by the Fed to message a pivot on its financial policy meeting there at the end of 2023 is planning to hold interest rates steady. And the policymakers say they've penciled in more rate cuts than anticipated, 75 basis points, almost 1% down in total next year, down to a policy rate of about 4.6% versus the 5.1% the last time the Fed had updated its projections. So that works in favor of profitability, and that profitability works in favor of the economy and market growth. That's still well above the 3.8% that they project they'd like to have it at, and that the markets are calling for. But it is a big decline that implies the Fed thinks it will cut rates more this year, 2024, which could then have a very positive effect on the economy and the markets. And I'd also point out that while it's not listed on this chart, the fact is with an election coming up, we know that election years tend to be pretty good, and that politics, for whatever reason, seems to play nicer, and that seems to create more of a positive reaction in the markets as well. Another point, the S&P 500 is less than 2% away from its all-time high, last seen in January of 2022, and the rally is broadening out from just big tech. I said a moment ago that big tech is what led or drugged the S&P 500 along, but that rally is now broadening to other companies and industries. Stocks and bonds have soared this month after the Federal Reserve signaled those rate hikes and that they are coming, and the 10-year Treasury yields closed back below 4% for the first time since July. This isn't a very forward-looking forecast, but it does identify some things that make me think that the economy and the markets could be better, that we could see some more growth and maybe see high single-digit or low double-digit returns this year. But again, we're just the money managers. You have to say, I'm good with taking some more risk. You have to let us know that, because as a fiduciary, our job is to make sure that we invest as you would have us invest. And that sometimes gets me in trouble, because sometimes I'm saying we should do more, but clients are saying, I just can't take it. And so we invest the way they indicate they want to. And then later on, when the markets do outperform, they're like, why didn't we invest that way? Well, because we can't go beyond what you tell us we can do. You're the boss. We're the employees. We make great decisions, and if you give us autonomy to do so, we'll do that. But when we don't have that autonomy, or we don't feel we have it, that can also impact these discussions as well. So that's one of my goals as we've been working the last 2 years to help our clients begin to see through planning, through risk reward assessments, through investment management, to get them to understand this team or partnership strategy we're using with each of you to create the best outcome and the best results in a way that matches what you feel comfortable with. So when I showed you this report last month, it was right about here. The market had just jumped up, and I had made a comment about how after those downs, those highs and lows had gone lower, but lately they had just taken off. Well, now we can see we're sort of in that channel right now where we're looking at the market going up, coming back down, testing that previous high back to December, middle of December like we were before. Now it's moved back up again. We can see that the relative strength indicators are well above the 50% mark, which makes me feel positive that we're looking at a significant potential to see it bump above this high. And if it bumps above this high, then that probably has a long ways to go. What is a long ways to go? I don't know. As I said a moment ago, maybe high single digits, maybe low double digits, but that would be a nice continuation of what we've seen from 2023. When we look at the short moving averages, convergence and divergence, we see that it's still well above its average on the short-term MACD, but we also see that it's staying up there, and this is playing well into that thinking, at least from a technical viewpoint. The technical analytics seem to support what we've been talking about. And again, as we go forward in this year, we'll be watching this every step of the way. With all of this that I've just shared with you, it all fits into financial planning, investment management, risk mitigation with insurance and tax and legal strategies. It all works together for your financial journey. And nothing has changed, at least in the sense that we want to plan wisely to get to retirement or redirection. And then once in retirement or redirection, we want to plan wisely to make sure we have resources to last as long as we do. And then of what's left, make sure that transfers to the people that we want to receive it, minimizing TFE, taxes, fees, and expenses, and all the while helping each of you to achieve your desired return on life. And that's what we're talking about here, whether it's planning, investments, risk mitigation, business strategies, all of it's designed to help you get from where you are to where you want to be. Now, I want to share with you a simple thought. Honestly, it's probably so simple that some of you are like, oh, I don't know why you're telling us this. We already know it. But I will tell you that I've shown this to people recently, and I was kind of surprised. They said, I've never thought of it this way before. When it comes to your portfolio management goals, you can kind of think of it as 4 buckets. Those 4 buckets represent savings as your first bucket, and then your investment buckets come in mid, short, mid, and long-term investments. Short is defined as anything from 1 to 5 years. Savings is defined in that first year. Mid is 6 to 10 years, and 11 plus years is classified as long-term. Now, with that in mind, I want you to think about what the goals are for these buckets. What's the goal? Well, the goal for savings, spend it all. Capital depletion, spend it all. Now, you might have shrunk back for a second when I said that. I'm not saying you should go out and spend it all, but I meet people that they'll save money, they'll have it in savings, they'll be really pleased with how things are going, and then some sort of emergency pops up, and they need to pull money out, and they feel like they failed somehow. But my point is they haven't failed at all. The goal of that bucket the whole time was to deplete it for that emergency. Or maybe it was an opportunity. Maybe it was something that you're like, oh, this is a great deal, I got to do this, and you deplete that bucket. Well, then you just you build it back up again. But the goal always was the same, capital depletion. Now, to put that in perspective, the goal for the short-term bucket is capital depletion. You say, I want to save money for a car. Great, you save the money for the car. Then you go out and you spend the money to buy the car. You depleted it. If you can get a good deal, don't have to spend all of it. That's just good stewardship. That's just wise money management. But the goal all along for that short-term goal is to spend it all. The goal for midterm, you save money to buy a house. You save money for the down payment on a house, or you want to pay for college education, or you want to do some big trip that you've been thinking about. Capital depletion, you're going to deplete it. Again, if you don't have to spend it all, that's fantastic. But if you did, that's what it was for the whole time. The only bucket that is different is the long-term bucket. And it could be for both capital depletion or capital retention. When it comes to retirement, it's about capital retention. You want to retain the capital to make sure your money lasts as long as you do. But for other goals like college education and so on, for maybe you had a grandchild or a brand new baby and you're trying to save for retirement or for their college plan, capital depletion. Let them spend it. That's what it was for. It wasn't failure, it was success. So when you put your portfolio management goals in this light, savings and investments, short, mid, and long-term goals, capital depletion, in some cases capital retention, that is how we put together the thinking for a portfolio. And by having that in mind, it makes it so you can avoid many of those lessons that I just showed you from 2023. As we've talked about before, and I'm not going to beat this horse anymore, but basically we see 8 investment models to work off of. Cash reserve for your emergency opportunity needs, bonds or loanership assets so you can have income generated to meet your retirement needs or other income needs you might have, equities to offset inflation to give you growth beyond what current interest rates are, real estate, which I think of as just a different form of equities. These are more liquid, these are less liquid, but both are really good inflation hedges. Tangible assets, which are more short-term goals using commodities or energy or anything that's sort of a tangible thing that you have to use. Currency, Using the US dollar against other currencies has been a pretty decent strategy for us and along the way. Business interests, which is like equities, except it is private. These are publicly traded, these are privately held business strategies. And so helping investors make the most of that portion of their portfolio is a way to offset inflation, maybe generate income, get some extra growth to meet their longer term needs. And then insurance and annuities, which provide risk mitigation assets for either protection of income or principal or catastrophic loss of assets or income. These are great tools to help portfolios be able to do the things that we talked about, which is create and grow wealth, protect and preserve wealth. And then these 10 strategies here are the various tools that we use to help bring these together. Keeping in mind that there is a cyclical nature to all investments. There's a peak to the investment cycle, and then there is a trough to the investment cycle. And that's true whether it's interest rates that cycle up and cycle down, stocks cycle up, cycle down, bonds cycle up, cycle down, real estate. All of these items do this. There's a peak, then there's an early downturn, a downturn in the trough, an early upswing, and then a full upswing. And by thinking in those terms, it makes it possible for us to do this little phrase down here, which is proactive wherever possible, reactive whenever necessary. Each of these asset groups have a cycle. They have a peak and a trough, and they have an early downturn and an early upswing, and being willing to look for that, to try to control your biases, to try to make decisions that make sense. And when I do say control biases, trust me, advisors have our biases too. We have to try to see through those and identify various strategies. That's why we get resources from people we agree with and resources from people we don't agree with, because we're trying to hear what everybody's saying to make the wisest decision, to cut the widest swath through human thinking in that process. But as we look at these various assets, and then we divide them out accordingly based upon a client's income needs or their flexibility needs or their cash reserve needs or their risk needs, their growth needs, etc. Trying to put all these together is how we build a portfolio for each client and to make it so that it is unique to each client's situation and needs. For those who are retired and are looking at pulling money out, we have a pretty simple process. On this side, we have what we call Strat Grow process, which are growth-oriented assets that are matched to our client's risk tolerance. And on this side, we have the income-oriented side, which are less aggressive, more conservative, designed to be able to have confidence that we can get income for that. And so that income modeling might be the client says, well, I want to have $5,000 a month. That's $60,000 a year. I want to know that I can rest comfortably, that no matter what's going on in the economy, I have 5 years of that. So 60 times 5 would be $300,000. They might have $300,000 in their income-oriented bucket, and they might have whatever that remaining portion is, 500,000, a million, 2 million, whatever, in this growth bucket matched to their risk tolerance. And every time that the market does better than 5%, then what we do is, or the growth strat portfolio, well, every time it does that, we refill the bucket again. So if it was 1 year, we refill it for 1 year. If it was 3 years before we had that growth we're looking for, then we refill it then. And by doing that, we're able to help generate good income, keeping their investments invested according to their desires, their risk tolerance, appropriately for their situation. While we have the tactical income account and the strategic growth account, makes it so that it helps meet their needs. And as I just said a moment ago, what we do is we replenish during the off years, or during the good years, and we avoid replenishing on the off years, and then we replenish again however that year ends up. And if you look at the little boxes here, from 2003 and 4, we had positive returns to replenish. 2005, we didn't replenish. 2006, we did. 2007 and 8, we did not. 2009 and 10, we did. 2011, we did not. 2012, we did. And depending upon how much growth you have 23%, it's easy to replenish 2 years of downturn. It's not a problem at all. And we're not ever selling out when the market's going down, because we're setting up their income distribution according to their risk tolerance and their income needs, and keeping the rest matched out for their longer term growth. All of that ties back together into their return on life financial plan, which really has three legs: their investment strategies, their personal financial plan, and their risk mitigation solutions. This is based on tax, trust, and insurance strategies. This is based on investments for the accumulation, distribution, and transfer phase. And the plan is designed to pull out the various situations and needs to create a fiduciary thought process for our clients. And it's, again, about creating, protecting, growing, and preserving wealth to meet clients' needs. By doing this, we think this creates a better way for the client to be involved, for us to be involved, and to make those 10 lessons I just talked about less of a challenge for people. This all comes back, though, to what you want, your bucket list. Unless you're Scrooge McDuck, you don't want to have a big pool of gold that you go swim in. For those of you who saw that cartoon, you want to do things. You want to travel, play, maybe do some mentoring, maybe develop a hobby, home projects, more time with spouse or family or friends, start a new business, do a new adventure, something that fits your retirement mentality, that identifies your vision for your return on life, to be able to make it so your time is divided out accordingly to what you want it to be, so that you're doing with the 168 hours you have and I have, using it in a way that accomplishes your goals, meets your desires and needs. It's the feelings and desires attached to the facts and figures of your situation. That would be what I would call maximizing your return on life. Last week or last month, I talked about setting goals. Hopefully you have done that. I've set quite a few goals for myself this year: business goals, personal goals, goals that are designed to help accomplish things that I want to do. Hopefully you're doing that as well. Hopefully you're not setting New Year's resolutions, because if you did, let's see it right now, it is the 16th. So you've probably already broken a couple, if not all, your resolutions. With setting goals, you just restart, you reset, you just go forward again. If you aim at nothing, you'll hit your target every time. That's what my grandfather taught me. And so that's why we set goals here. Make them smart, specific, measurable, achievable, relevant, and time-based. And that way you'll be able to achieve. And if you want to have more conversation about this in your next appointment, please let me know. I'd be more than happy to talk with you individually about this. As a quick reminder, the 4 applications that we give to all of our clients: your financial dashboard, your portfolio dashboard. This encompasses everything but doesn't have much performance reporting. This is the items we manage for you. This does give you some very, very detailed performance reporting. Your risk reward assessment, that tool here can help us make sure that your portfolios and investments that you have with us and outside of us are matching your risk reward score. And then your financial life plan, which is tying the feelings and desires, your ROL, to the facts and figures of your financial situation. These 4 are available to you. If you're not sure how to use them, please let us know. We'd love to help you use them. The additional planning tools, we provide you a financial dashboard, gives you 24/7, 365 access to your financial information, report suites that are available to give you all kinds of data to hand out to your team if you need to see some information, electronic vault for protection of critical assets and document storage needs, planning and wealth management reviews every 4 months for our planning clients, beneficiary estate design and income tax reviews for those same clients, annual risk management assessment for any of their insurance programs, return on life review and update for their transitional and life goals, and then monthly advisory review. That's what we're doing right now. Those webinars updating you on wealth management strategies and economic and market issues. Hopefully you're enjoying these. I see that sometimes we have waning numbers, and I see all of a sudden it takes off, we have bigger numbers. Please join us and invite your friends so that they can benefit from this as well, because we're just doing this because we care. So my final thoughts for today: continue, as always, to monitor the economic and market conditions for both opportunities and threats. And this is not all sunshine and rainbows. I'm more than happy to talk about threats, but I just don't want to let threats be the thing that drive us all the time. Not learning from history is a plan for future failure. You know that, you've heard that before, but that's what I just showed you. Discipline, diversification, and understanding your risk reward tolerance are crucial for making your investment portfolio effective in meeting your family's financial goals. Identifying your investment expectations and communicating them with your wealth management team is critical for financial satisfaction. Understanding your investment portfolio management goals is essential to making intelligent investment decisions. Setting goals can help connect your personal desires and feelings to the facts and figures of your family's financial situation. And fiduciary wealth advisory, what we do, requires a dynamic financial planning strategy to help you and your family manage wealth wisely in today's complex economic environment. So I'm going to check here in a moment, see if you have any questions. So if you do, maybe start typing those in or raise your hand. I'll go to that part of the app in a second. Again, if you have questions after this webinar is over and you think, oh, I'd like to get an answer to that, please email us at info@Frank's office after the webinar, and we'll be happy to get with you and answer those questions. Our next update is February 20th at 5:30. As always, we're going to be talking about creating, growing, protecting, and preserving wealth and income for your family. Take a look at the markets and the economy. Take a look at strategies for in next month's review on understanding confirmation bias or biases that impact our risk management, plus a few other things as well, and then take time to answer your questions. I hope some of you now are checking out our weekly updates. We've seen a growth in the number of people who are looking at that. You can find those on Facebook, on LinkedIn, and on Twitter. Well, not much on Twitter yet. We're growing to that one. But these are available. They come in your email, so please take a look at them. They give you information in between these advisory reviews. And I pay for that, so I want you to be using it occasionally. That way it might help you with some questions too and some thoughts. So what we covered is the market and economic review, 10 investment lessons we learned from 2023, looking ahead into 2024, portfolio management goals, investment allocation blueprint, income to growth ratio. I shared with you my final thoughts. I'm going to take a moment here to answer questions and update you on the next advisory review. Let me see now if we have those questions. Oh my goodness. So GoToWebinar has changed on us. Wait, what? No, I don't want to do that. Oh, technology has been one of those days. Nope, not doing that either. Okay, so it changed on me. So I don't see any hands raised.
Frank?
I don't see any. Yes?
I don't see any questions. I just checked the little icon.
Okay, that's Stephanie talking right now. I don't know if you can see that on your screen, but that has her name by it. So thank you, Stephanie.
You're welcome.
All right, well, that's all I have for tonight. Hopefully this has been useful for you and that you've got a couple of new ideas that may help you to feel good about what's going on and to make 2024 better for you. I'm about to go have dinner. For those of you who didn't know, in November I got married. I think you all know, but I got married, went on my honeymoon last week. The lovely and gracious Jane is my new bride, and so I'm going to go home and have dinner with her, and I will look forward to talking to you along the way here, whether it's the next advisory review or a meeting in between. I apologize for running a few minutes over and for starting a few minutes late. Next month we'll get this nailed down. Until then, have a fantastic week and month, and I will look forward to talking to you soon. Have a great evening, and God bless.